So it's time to dive into some deeper understanding about Fibonacci, advanced Fibonacci. And that is just basically better understanding how the different levels are respected and how the extensions for the Fibonacci works and which levels are respected and how they are respected. So first and foremost, we pull out the Fibonacci tool and we look at it. So the levels I'm using for the retracement is 23.6, 38.2, 50%, 61.8%, 78.6%, 88.6, and then we got the extension, the negative extensions that are 127.2, 161.8, and then we got the top side extensions, negative 27.2 and the negative 61.8. Now there's a reason for 50% and 61.8% being yellow. And there's a reason for 78.6 and 88.6% being red. And I've mentioned it previously in the first Fibonacci video. If you haven't watched it, go back and watch it. Make sure you understand everything there before you continue with this video. Now to give a quick recap on what it was. So the 50% to the 61.8%, we call it the sweet spot. It's a sweet spot because this is a zone where market likes to retrace to. Market moves, creates this top and then retraces very often to the sweet spot zone. Why? Because very often you will find imbalance here, you find liquidity and then pushes up from there. The red zone below it, the 78.6 to the 88.6%, is in this case here the demand zone. If we pull the Fibonacci from upwards down, then it will represent the supply zone because market pushes up, people are selling off, so therefore a lot of supply in the zone and market retraces. In this case here, market pushes up, retraces, and it retraces to this so-called demand zone. Why? Because it's a price level, it's a zone where you will find a lot of buyers that are willing to buy for this discount price. And if market managed to push all the way down here, it can fill a lot of orders and then make a good push up from there. So very often when you see market hit this kind of levels, you will see a good push from there. Same thing when it hits the sweet spot. So what we mostly use Fibonacci for is for looking at retracement levels. So let's say the market is pushing up. It does this. We pull Fibonacci from this bottom to this top. And now we're looking at the retracement levels. So the most popular retracement level is Jeremy here coming in with a quick message. Now I want to say, make sure you don't miss out on any of our live streams. We have our live streams Tuesday, Wednesday, and Thursday on YouTube on the Prosperous channel, and they start 8:45 up until 9:30. Sometimes they go even longer depending on the volume in the markets and what's happening, but we're always trading the London kill zone. So 8:45 Central European time is when we're starting. Don't miss out on them because we're catching trades live and you want to be on those trades. This is something that I used to charge money for before. This is something I used to have behind paywalls. I'm doing it for free right now, all right? So don't miss out on that. Also join our Telegram community. It's booming. There's a lot of stuff happening there. Link is in the description box below. Make sure you like, subscribe, and put the notification bells on so that you know when we're going live. So you get notified when we're going live on the streams. All right, with that said, back to the video. The most popular retracement level is the 38.2. Market very often likes to bounce up from here. All right. But if it doesn't hold, then it's the sweet spot. If that doesn't hold, of course, it's the demand zone. So you get 3 levels to watch out for. Now, which level will it be? Because of course, we cannot get stopped out 2 times to eventually get the trade properly executed down here. Now, we use this in confluence with other things that we see to the left, that we see here in the market structure. And that is, of course, supply and demand zone, order blocks, liquidity. So for example, if we would see a lot of liquidity laying around this area here, then we know that the sweet spot is super valid for us. If we see a strong order block down here, then we know that the demand zone is super valid for us. If we see nothing specially here that will pull down the market, then we go for the 38.2. And if you want to see my Fibonacci settings, then this is what it looked like. You can print screen this and use it, or if you have your own settings that you want to use, your own choices of color, And also a quick pointer before we jump into the real markets, that when I use negative Fibonacci, so when I'm measuring the retrace from a downtrend, then I always use the striped lines. So this for me means that it's a negative Fibonacci. So let's look at all of this on the real markets. Okay, so here we got some price action on gold, and we're on a 4-hourly time frame. So on the 4-hourly time frame, y'all remember from the market structure video, the advanced market structure video, that we want to see candle body close above the previous high for it to count as a break of structure, or below previous low for it to count as a break of structure in a downtrend. So we have for here, for example, a low. Let's say this is the high. We have the low, and here's the high because it broke the structure. Low, we have the high, we have the low, we have another high, and then we start pushing downwards. Now our focus is Fibonacci. So let's look at how Fibonacci comes in to the situation here. Let's say, for example, market pushes from this low to this high. Down here, we can already see we have a strong order block, and this is order block right here. So we already have a sight on this zone here. And what Fibonacci levels match best for this whole order block here, this buy order block? Well, it's of course the 78.6 and the 88.6 Fibonacci levels, the demand zone, the Fibonacci demand levels. So what does market do? It retraces all the way down here and starts to push up from there. Now, that's a very chopped market, a lot of back and forth here. But what I want to show you now is when it's more clean. And this is a clean downtrend that we got here. A very nice downtrend. Okay. Let's mark out the levels first, so I get a repetition on that. We had the low. And this low actually broke this structure here. So here we're starting a downtrend. A bearish sequence. And therefore the red dots. Low, lower high. So here we have the lower low, here we have the lower high, another lower low, another lower high, and then another lower low before we break this whole thing here. All right, let's look at this a little bit. Here's a higher high, and then again we break it downwards all the way down here. So first and foremost, we broke structure here, right? We had a change of character. How do we know how far it's going to drop past this change of character? Well, this is when Fibonacci comes into play. So we pull it from the lowest point, which is here, the lowest point to the highest point. And what do we see? The Fibonacci extensions, the 127.2 is perfectly aligned as support for this break downwards. All right. And it bounces off that level. So when you see change of character, market breaks the structure, you can almost always rely on that market will hit this level. And this is where you can put your take profit in this case here. And most often than not, you will be right when you're putting your take profit here. Now that is for change of character. So market breaks down, okay? In the continuation of a trend, what happens then? Well, let's look at it. Let's take it from the top here, for example. Highest point. Lowest point. What do market do? It extends all the way to the 27.2. All right, so let's look at the continuation of a trend, and let's start from, all the way back here. So we have the low, we have the high, and look at the extensions. The 27.2 smashed, the 61.8 also smashed. To be safe, I'm always having the take profit at the 27.2. But if I see something that might attract the market further up, I'm using the 61.8 as a take profit. But I will trail the stop loss all the way. So we don't want market to turn on us from this level and then we lose the profits. So spot on the 61.8 extension. Now market reverses. Let's take it from this top to this bottom. Almost spot on at the 27.2 extension. All right. Continuation. Even though this is an internal trend, it doesn't matter. It's still a continuation of a trend. And when we're measuring Fibonacci levels, then it doesn't matter. We're always measuring the swings. Doesn't matter if it's internal or external swings. It's the same thing. So this top to this bottom, market retraces all the way to the supply zone and then pushes down to where? The 27.2. Spot on. Now let's look at other levels. So market pushes from this top. Let's start with this bottom here. When it comes to Fibonacci, it doesn't matter if the body closed below or not. It's the wicks that count. And what does the market do? Retraces to the 30.2 and then perfectly smashes down to the 27.2, almost down to the 61.8. So if you would have entered here for a sell and put your take profits on the 27.2, you would have made a nice trade and a nice profit. So let's look at another swing. Where do we got another swing? We got another swing. And what does the market do? Perfectly respects the 27.2. Not perfectly, but it respects it as well. So market comes, retraces all the way to the 30.2 as always, and then pushes down to the 27.2. So another great trade here, downwards. So you see the pattern, you understand the logic of this. We have the Fibonacci extension levels. When is a change of character, like in the situation here, for example, from the bottom to the top, and then market breaks out, you want to know where it's going to reverse from, you can always count on 127.2 or 161.8 being perfect levels for that, all right? But if market continues on a trend, then of course, fib from the bottom of the last swing, of the last low, higher low, to the last higher high, we see the retrace, perfect. And what do we see more? The extension, perfect. In this case here, 61.8, perfectly respected. All right. And look how beautiful this is. As I said, this is a sweet spot zone where very often you will find liquidity. The market needs as few to keep moving on. Here we have a lot of imbalance. You will learn more about that in the liquidity lessons. Just below it, we have the sweet spot. So it's a perfect target for market to pick up liquidity and then to boost up from there. Now, with that said, you slowly start to grasp and get the picture of how we find entries in the market and how we find the levels that we target in the market. But still though, this is just the start. We're still just scratching on the surface when it comes to entries and finding take profit levels. So stick with me and you will soon understand the whole strategy, the whole concept that we use, the escape the matrix concept. And I can promise you, if you understand the strategy, if you master this strategy here, not even the advanced stuff, just the basic stuff, you will be highly successful in your trading.